Hello and welcome to this special episode here on Money Paathshaala. Joining me today is one of India's brightest fund managers, Ankit Pande, who's the fund manager at Quant Money Managers, one of India's fastest growing mutual fund houses. Ankit has almost a 15-year track record. He has been an analyst and now he manages investors' money as well. Thank you very much, Ankit, for joining me here today. I think the big question today on everybody's mind is that it's been about a year and a half to the markets don't seem to have gone anywhere. And when people look at their portfolios, they see, pretty much where they were. And even if you look at the broader indices, we hit 62 and, we kept taking it back, up, down, but net pretty flat. And I think I was speaking to some of your peers in the industry, and they feel that that's probably one of the reasons why people are stopping their SIPs increasingly. I'm not saying all of them are, but my first question to you, since you also work with mathematical models at Quant, is how should investors approach equity, when they invest in it? I was having a conversation just the other day of somebody saying, oh, it's been 1.5 years. And my reaction was that, look, you shouldn't have entered if your horizon was just 1.5, 2 years. But would like to hear it from someone like you as to what should be kept in mind when investors put their money in equities.
Well, thanks a lot for having me on, first of all, Vivek. And it's a pleasure to be onto your platform. But very importantly, I think very basics of equity is that it is a risky asset class, quite different from fixed income, quite different from a lot of Indians, how we invest in gold, quite different from having just cash liquid in your bank, which does lose purchasing power with inflation. And therefore, there has to be a certain amount of risk appetite that you have to be prepared to take on, according to one's age profile and according to one's wealth affluence. And that is one finding that has come straight out of a research paper recently in the Maharashtra region across various cities. So that is one thing that is very clear, that look, you have to have the gumption to take on some risk, and you have to apportion certain part of your wealth to this risk bucket of investing, which is in the equity asset class. And of course, naturally, if you are younger and if you have more wealth, you will be prepared to take on a little bit more risk. That is very much the matrix that governs how you invest in equity. But really, to look at equity over a longer period of time, I think it is extremely essential. It is vital to get onto the equity train at an early age if possible. And again, to an appropriate extent as per one's risk profile and wealth affluence. Because over a period of time, money, especially the way the banking system is today in the world and in our country, money does lose value. It loses purchasing power. When our money supply growth by various banking statistics in India, and if you look at the world, you can look at the US dollar money supply growth. When that is growing in the region of 9, 10%, sometimes 12, 13%, and in the 1990s, it used to grow by 25% per annum, that is more money in the hands of those who printed first. And you're not having that initially, are you? So you have to either keep your income growing at that pace, which is very difficult. Maybe in the initial years, if you are fantastic and very brilliant at your job and your career, you will progress at that rate. But it's difficult to keep up with your income at that kind of pace. So you have to keep up with those who have the power to print money at that extent. And therefore, I think you have to, there's no option to, over a longer period of time, you have to allocate quite a bit of your attention and your wealth resultantly in those assets which benefit from this money printing or inflation, as it used to be called classically. So I think equity is that asset class which can help you get there. Fixed deposits and gold, they are different kinds of assets with different perspectives. But equity is so vital over a longer period of time, and that is the single most important asset class to understand well and to apportion your wealth to over the longer period of time is how I would do.
Ankit, a lot of people increasingly, especially young people, and not just young people, spoken to people across age groups, tend to feel and believe that, the minute the returns from their mutual funds do not, say, mirror what their expectations are over a short period, they feel they can do it themselves. They can trade themselves. And if you see, even in the last 2, 3 years, the data before us, whether it's the opening of demat accounts, trading accounts, all seems to be pointing in one direction, which is up. You're someone who has the experience of having been an analyst, you're a CFA, and you're now with a mutual fund. How difficult, what would be your word of caution? People think, oh, it's all just about getting on there online. Technology today allows you to do things so easily in the capital markets. And it's all about just going and, buying a few shares and selling them. Can you take our viewers through how difficult it is to pick stocks and what goes into picking a stock when you, as a fund manager, is actually buying shares?
Right. So I think we're talking about the direct way of investing into equity, which is analyze the share, analyze the company, analyze its financials, analyze how the company's shares are owned in the equity market, and then make your investment call, whether it is to stay away or to invest or invest more. But remember, there are not only just this direct mode of investing in equity, is what we talked about in the first question, but there is also other modes of investment. Incidentally, I think direct investing in equity is probably the riskiest way. It's probably the highest risk way of getting involved in equity markets. So we'll come back to this question of if there are other ways to invest. But I think coming back to this, to the salient question of how do we invest in a particular stock, or how does one invest directly in a particular stock? It's a multifaceted question. We look at Quant Mutual Fund, we look at multiple ways of analyzing the company. As I said, not just the financials, not just the recent growths and the return ratios, which is being the assets that have to put in to make the company. Not just the basic financials, but also we try to take a look into the structure of the company, who has invested, when they are investing, the timeliness of other investors coming in, new investors coming in, the timeliness of other investors wanting to go out, large groups, right? Private equities, who typically have a 5, 7, or 10-year time horizon investment. And then when they go in and out, they change the structure of the company, who owns it. So when you are investing in a company, there is a multifaceted analysis to be done. And both from the long-term perspective as well as short-term perspective, there are many things that can change your investment conviction in a company. To understand how do we invest in the direct fashion, we not only go deep into company financials, but also understanding the company's equity structure and the investor patterns and the behavior. So we love the behavioral analysis part of the investments. And also we try to gauge in the macroeconomic environment, how is the risk appetite of the general investor, which is going to change significantly the way the mass investors go in and out of certain types of stocks. Okay, there are many types of stocks. There are large cap companies, there are mid cap companies, there are small cap companies. So these various buckets of analyses, risk appetite, liquidity analytics, we call it, right? The structure of the company, as well as the fundamentals of the company, we call it the V, or the valuations part. We take them in when we choose to invest in a stock, or this is what you should do as well, or try to do as well. Coming back to one little part that I mentioned earlier, as far as trying to gauge if there are other ways of investing in the equity market, not just the direct way. So I'll just complete this here, and then I'll hand it back to you, Vivek. But there is AIFs, alternate investment funds, There is a PMS, which is a portfolio management services that high net worth individuals can access. And then there are mutual funds, just companies like ours. And I think progressively, as I mentioned these names, the risk goes down. So I would say mutual funds are sort of the least risky way to invest or access equity. And again, this is affirmed by another recent study that there was in Andhra Pradesh University, who said that, even as secondary market investing is only about a choice for about 20% of the mass. But really, when you look at the 40 to 60-year-old age group, which is perhaps your earners and your family investors, these people, or this cohort, the vast majority of them, about more than 60% of them, prefer investing in equity via only mutual funds or secondary markets, as they are called. So that is again something that you should take on board, that as you mature and as your risk profile is maturing, you will probably end up in the secondary markets or the mutual funds, because they kind of take care of your risk from multiple parameters.
Ankit, the same people who would normally rush to a mall if there was a discount sale on, not even caring about whether there's COVID or not, the same people would be reluctant behaviorally to pick up equity when it is available at a lower price. And if you have an SIP running, you're actually accumulating units at a lower price. But instead of doing that, there are people who feel, hey, let me just hold on and pause or stop my SIP for the time being. So here's my question. What is your outlook for the next 3 to 5 years? I don't know what periods you look at through your models that you talked about earlier, but what is your outlook for the next 3-5 years?
Vivek, we are extremely positive and constructive on the equity market, specifically in India. It comes to the point that, at the end of the day, equity is an investment where there will be tremendous bouts of volatility, and your risk appetite as an investor will be put to the test repeatedly, probably in 2-year cycles, definitely in 5-year cycles, for sure. And therefore, if one is prepared beforehand to invest in a systematic way, and SIP, it's coincidental that it has that systematic name in its acronym, but really, if one had to have a pre-planned arrangement as to how to approach the equity markets, that would be most helpful. One can look at any number of simple mnemonics as to how to go about it. One can approach it, given the way historically equity markets, when they correct sharply, they can lose more than 50%. You can have simple rules of thumb to approach a planned investment approach in this way, in that if the equity market is down X%, you will invest more. If you really have to do it this way, it's I would say, a more smart way of approaching your SIPs. If one investor does not like the way SIPs are being handled or being advertised, there are these apprehensions that investors have, then you can yourself, as an investor, as an informed investor, approach the markets in this way, keeping in mind your own risk profile. I keep coming back to that. Your own risk profile, and keep your powder dry, they call it, right? That's a simple way of understanding that you should always have a liquidity to service your own basic needs, your own family. And, typically in the salary class or in the business class, it's not uncommon for people to keep 6 months to 1 year of liquidity with themselves all the time in their houses. That's not uncommon. And that's only very smart management of your own personal liquidity needs. So beyond that, you can approach equity markets in that way. And coming back to the point of how we are constructing assets with our portfolio over 3 to 5 years, look, the way we say it is that investors should continue to invest in equity markets in a systematic way, and leave the timing aspect to the particular mutual fund scheme, or whatever you trust and you follow. You should invest consistently and leave the timing aspect, the tougher aspect of the equity markets, to the particular company, to the particular fund manager. And that's where a company like ours, Quant Mutual Fund, we have models that can perceptibly gauge the risk appetite and risk behavioral patterns, reaching out up to 10 years even. We follow some leading macroeconomic indicators, and we have an incredible source of data that we have spent tremendous amounts over the last 15 years of our existence, gathering and having an expertise in. So, it's a question of handling your own risk appetite, yes. But if you're asking me as a portfolio manager or a fund manager, what are you doing? I would always say we are looking to invest very smartly, and our investors should be smart enough to recognize that there is a lot of good things about equity. If you do it well, you will succeed and you will prosper, is what our assurance is.
It's been a pleasure talking to you, Ankit. Thank you very much for taking time out. I look forward to many more such conversations with you. I know you're extremely passionate about educating investors, and it's wonderful the effort that you put into it. Thank you very much for taking time out from your hectic schedule, if I may say so, at this point, given the way the markets are moving. Thanks very much.
My pleasure, Vivek.